everyone, welcome to part 2 of this video on 21 stocks with blockbuster Q3 results. Before we proceed, in case you have not watched the first part, please pause this video and watch the first part. Because in that I have covered 10 stocks out of 21 stocks and remaining 11 stocks I would be covering in this video. Again, just a disclaimer that it is not a buy or sell call. I am just sharing my knowledge with you all and expect you to do your research before investing your money. Needless to say, my videos are only for long-term serious investors. Alright, let's get started. So 11th stock in the list is JTL Industries. It's a manufacturer of various steel tubes and pipes that include ERW steel tubes, galvanized steel tubes and pipes and so on. Company has been growing at a very fast rate with revenue growing more than 10 times in last 5-6 years and net profits are up around 15 times. In the latest Q3 result, company has posted a volume growth of 76% year on year, revenues from operations are up 65% and PAT is up 47%. I recently did a detailed fundamental analysis of JTL Industry where I explained the growth potential in the company which is driven by ongoing infrastructure boom in India. So there is huge demand for JTL steel tubes and pipes across sectors including warehouses, airports, railway, affordable housing, Jal Jeevan Mission and so on. Due to its growth potential, company is expanding its capacity big time and management has guided for revenue target of 10,000 crore by FY27. For reference, in FY23, company revenue stood at 1500 crore. So you can see the potential. In fact, recently management has issued warrant share of the company at 270 rupee, which is higher than its current price of 250, which is very rare. And that's where I see a lot of potential. I would strongly recommend watching my detailed video. Currently, JTL is trading at around 250 rupee and a PE ratio of around 36, market cap of around 4,300 crore. So considering the growth potential in the coming years, JTL is looking very attractive. 12th stock in the list is Craftsman Automation. Craftsman is basically a precision engineering company with around 35 years of history that manufactures various components and sub-assemblies for automotive, industrial and engineering segment. Company has also launched storage solution where it provides complete warehousing solution that has immense growth due to the growing e-commerce sector. Company's revenue and profits are consistently growing at a very healthy rate in the last few years and its latest Q3 numbers are rock solid with revenue growing 51% year on year, EBITDA up 39% and net profits up 42% year on year. Company has been expanding its presence across passenger vehicle segment. Then in FY23, company has made an entry in EV segment in both powertrain as well as aluminum division. And then company is also expanding its storage solution with cold storage, multi-commodity storage and so on. Craftsman share price has grown significantly in last few years, but recently there's a good correction. Currently it is trading at around 4,300 rupee with a PE ratio of 28 and a market cap of around 9,000 crore. At current levels, it is looking attractive to consider accumulating. 13th stock in the list is Kaynes Technology. It's a leading electronics and IoT product service provider across sectors including automotive, industrial and EV, railway, medical, aerospace, outer space, IoT and so on. Company has been growing at a very fast rate with revenue growing more than 3 times in last 3-4 years and profit growth of nearly 15 times. As a result, company always command a premium. Now again in Q3, Kaynes has posted stellar set of numbers with sharp jump in order book, revenue growth of 76% year on year, EBITDA growing 70% and PAT up 98%. So profit has doubled. Even margins have expanded. Now currently Kaynes is trading at around 2,800 rupee, P ratio of 125, market cap of around 18,000 crore. So valuation is certainly expensive at the moment, but since Kaynes is growing rapidly, it is commanding a high premium similar to Dixon Technology. In fact, its share price has grown nearly 3 times in last 1 year. I remember covering Kaynes in one of my videos when I covered the entire electronic sector in India and its future growth potential. So as far as future is concerned, like I said in my previous video, I think the electronic story in India has just started and leading players like Dixon, Kaynes would grow at a very fast rate. Although their current valuation is a concern as they are trading at PE of more than 100. Having said this, the opportunity size is also big, so it's a bit tricky call. If you look at shareholding pattern, both FIs and DIs have added stake in the company in latest December quarter. Although the stake sale is from promoter, but this is a planned stake sale to institutions via QIP. So that would build investors' confidence. So if you think that electronic sector has a bright growth potential, maybe Kaynes can be added in a systematic manner. 14th stock in the list is Satin Credit Care. It's a new company in my tracking list which is basically a microfinance institution. Now I've done my research on microfinance segment of India and covered Credit Access Grameen that also posted stellar Q3 result. However, Satin Creditcare is one-third the size of Credit Access Grameen with a market cap of 2,800 crore, and interestingly, company commands a price to earning of just 6.8 and price to book of 1.47. So valuations are quite attractive. In latest Q3 result, Satin Creditcare disbursements have grown 56% year on year and AUM has grown 44%. Company's asset quality is also significantly improved quarter on quarter with gross NPA at 2.4%. Then company's PAT has grown 97% year on year and company's ROA and ROE have also improved. So overall, it's a great performance from Satin Creditcare, and the fact that it is trading at much attractive valuation with a PE of just 6.8 and price to book of 1.47 as compared to its peers, that makes it an attractive investment opportunity. In fact, recently both FIs and DIs have added significant stake in the company. Although a part of it was sold by promoter to onboard institution, but net public holding has reduced in the company, which is a very positive sign. 15th stock in the list is Varun Beverage. Although I've been tracking this company for a long time, but discussing it on YouTube for the first time. Varun Beverage is the largest franchisee holder of PepsiCo in the world, where it produces and distributes a wide range of carbonated soft drinks, non-carbonated drinks, and packaged water sold under trademark owned by PepsiCo. And Varun Beverage is a consistent compounder over the years with extraordinary growth in revenue from 1,800 crore to 16,000 crore in last 12 years, and net profits growing from 25 crore to 2,100 crore, representing nearly 80 times growth. Look at the margin expansion over the years. As a result, Varun Beverage share price has also grown leaps and bounds over the years. I thought of covering it when the share price would correct, but this company is just growing consistently every quarter. In Q3 also, company's revenues have grown 20.5% year on year, EBITDA up by 36% and net profits up by 76%. Currently, Varun Beverage is trading at around 1,400 with price to earning of 90 and market cap of around 1.8 lakh crore. Although valuations are expensive, but it is an SIP grade stock. Company has been expanding big time in Africa region, and Indian market also offers a lot of runway for growth due to ever increasing portfolio of beverages and growing demand for the new products like energy drinks. Now next two stocks in the list are quite interesting. I remember covering them during their IPO long back, but never got a chance to cover them post their IPO. So stock number 16 is Indigo Paints. I covered it during its IPO 3 years ago when it was launched at around 1490. And company received a stellar response with share got listed at 75% premium. However, over the next 2 years, stock tanked more than 60%. Now the stock is again back to its IPO level, and in Q3 result, company's operational income is up by 21% year on year, EBITDA up by 50% and net profits have zoomed to 43.5%. Company has been consistently gaining market share in paint industry and growing at 3 to 4 times as compared to the overall paint industry. Interestingly, Indigo Paint is a small cap company with a market cap of about 7,000 crore, PE ratio of 50. That looks quite attractive considering the fact that Indigo Paint's management aspire to grow the company at 30 to 40% CAGR rate in the coming years. Maybe I can do a detailed fundamental analysis on Indigo Paints. Stock number 17 is RateGain Travel. I still remember covering RateGain during its IPO in December 21 when the IPO price was around 425. I mentioned that I like the company and it's worth subscribing to the IPO. However, over the next few months, RateGain share price corrected significantly and I received a lot of negative comments. Fast forward today, RateGain is trading at around 875 rupee. Company share price has grown nearly 3 times in last 1 year. The reason is its exceptional financial performance. Company's revenue did fall during COVID period, but then it has zoomed nearly 3.5 times. Look at the consistent margin expansion. The reason for such sharp margin expansion is due to its SaaS-based business model in travel and tourism sector, and that resulted in strong operating leverage. As a result, company's net profits have zoomed multifold times from loss of 29 crore to currently at profit of 129 crore. In latest Q3 result, RateGain has again posted stellar set of results with revenue growth of 82%, EBITDA growth of 124% and net profit growing at 200%. Although the valuations are quite rich at current levels with a PE ratio of 80 and EV to EBITDA of 52, but the growth prospects are looking super bright where company has currently won orders worth 2.3 times the last year. So more explosive growth is expected ahead both organically and inorganically. Company management has guided to achieve revenue of 2,000 crore in next 3 years with EBITDA of 25%. So that would translate to operating profit of 500 crore and currently company has done trailing 12-month operating profit of 168 crore. So that's 3x growth potential in EBITDA in next 3 years. No wonder even institutional investors have shown interest in the company where it's done its QIP in last quarter. So even though PE is looking expensive today, there's a lot of growth in the coming year and hence rate gain can be considered even at current level. Now 18th stock in my list is a recently listed company that I've started tracking. It's Nuvama Wealth Management. Basically it's a wealth management company and got listed in November 23 where it got demerged from its parent company Edelweiss at price band of around 2,700. Company has posted a stellar Q3 result with revenue growing 38% year on year, PAT growing 66%. Its share is currently trading at around 4,200 at a P ratio of 28 and EV to EBITDA of 8 and market cap of 15,000 crore. Now if you look at the wealth management sector in India, it is still in nascent stage. With the rise of affluent Indians, wealth management sector would grow multifold times. This slide shows that professionally managed wealth in mature market is around 75%, whereas in India it is 15%. I also think that wealth management as a segment would grow big in the coming years and I am planning to do a separate video on this. Stock number 19 in my list is from hotel sector. It's EIH Limited. It's the parent company of luxury hotel brands of Oberoi, Trident and Maiden. Company is also engaged in flight catering, airport restaurant, project management and corporate air charters. I remember discussing the potential in Indian hotel industry last year and covered EIH as one of the leading company in the list. Now Indian hotel is going through one of the best phase of growth with both ARR growing and occupancy rate rising. As a result, hotel companies are big beneficiary of this trend. EIH posted sales growth of 26%, EBITDA growth of 55% and net profit growth of 62%. Currently EIH is trading at PE of 45 with a market cap of 25,000 crore. I think that considering the growth potential in Indian hotel sector, EIH is looking attractive. Although I like the entire hotel space at the moment where I have highlighted Lemon Tree as one of my preferred pick last year. And I think it would continue to do well. Then stock number 20 is Interglobe Aviation, parent company of Indigo Airlines. Now aviation sector is a bit tricky sector where we have seen many companies going bankrupt including Jet Airways. The reason is it's a capital intensive business and the margin fluctuates a lot due to dependence on crude oil prices. However, Indigo Airlines has created a niche in this space with its no-frill, low-cost model. And today, it commands a market share of more than 60% in Indian aviation sector. And from investors' perspective, the best part is that it is making a lot of money. Indigo struggled badly during COVID with huge losses, but look at the recovery. Company sales has zoomed significantly, margins have expanded rapidly, and company has made huge profit in trailing 12 months. In Q3, company has posted income growth of 30%, EBITDA has grown 61%, and net profits have zoomed 110%. Company is consistently expanding its presence in India and has also expanded to multiple destinations outside India. Last year, Indigo has placed record order for 500 aircrafts. Now, considering the growth trend for travel via airplane, Indigo is bound to benefit from it. Currently, it is trading at levels of around 3,000 rupee at a PE of 16 with a market cap of 1.17 lakh crore rupees. Now, final stock in the list is Zomato. This is probably one of the most discussed stock in the country with people divided into two groups where on one side you have believers in Zomato story and on another side you have disbelievers. Now we have seen how Zomato share price tanked badly last year because of weak performance and expensive valuation. However, company's management has given strong growth guidance and in Q3, company has posted stellar set of numbers that even the disbelievers would agree to. Company's revenues have jumped more than 50% and EBITDA stood at 125 crore versus loss of 265 crore. As far as future is concerned, company has given a growth guidance of 40 to 50% in the coming years, which is a very aggressive growth. Now that Zomato is turning profitable, it would be interesting to see the impact on the bottom line and how margins expand over time. Even domestic institutional investors are now showing a lot of confidence with consistent buying in its shares. Today, Zomato is trading at levels of around 150 with a market cap of around 1.38 lakh crore. Now, there's no doubt that the market for food delivery is huge and it would continue to grow, and Zomato is now into multiple business of home delivery via Zomato, then Hyperpure, which is in B2B business, and it has acquired grocery firm Blinkit, which is also growing exponentially. So growth is certainly there. The only question is valuation. Honestly speaking, I have no clue how to value it. It's just too difficult even for the market expert. Now you can either keep your faith in the company and give it a shot, or you can stay away from it. Personally, I've started liking Zomato after the turnaround story. We'll track it closely. So in these videos that were divided in two parts, we discussed 21 stocks with blockbuster Q3 result. If I summarize, in first part we covered Tata Motor, Trent, KPIT, Newgen, CDSL, Sansera Engineering, Home First, Credit Access, Dixon and IdeaForge. And in this video, which is the second part, we covered JTL Industry, Craftsman Automation, Keynes, Satin Credit Care, Varun Beverage, Indigo Paint, then RateGain Travel, then Nuvama Wealth Management, EIH Hotel, Indigo Airlines and Zomato. Now tell me in the comments which is the stock you are buying after Q3 result. Also let me know if you want me to cover any specific company. By the way, I've already shared the plan for coming videos on the community. I'm doing a lot of research and there are many informative videos coming ahead. So stay tuned, and if you find the video useful, do share it with your friends. And if you want to join my exclusive community, you can explore my weekly video series where I share one exclusive video in a week along with my own portfolio details. I always say that there's a lot of wealth opportunity ahead of us, provided we make an informed investment decision and do not panic. Patience would be the key here. I'll see you next video. Till then, take care.